Hello, class. Another podcast explaining how to do the exercises for deferred taxes. A little different format, and would be perhaps if information were given to you differently in a problem. There's no set way that this would be set up in real life in situations. But some way or another, you need to identify the differences between the tax return and the income statement. So in this case, what we're going to do is just a little different scenario, different same numbers, but instead of giving you what's common between the two, we might have a problem where they give you, or you are looking at an income statement completed, all done, except for the taxes, and that income before taxes is given as 226,607, and that's exactly what it was in our when we did the exercises before. So the answers are going to be the same, but this will look somewhat different. We take the permanent difference off before we get to taxable income no matter what, so that part isn't different. But then, as you'll notice here with bad debts, instead of looking at two columns and comparing the two bad debts, we take the difference in bad debts for the current year, and we just add that back to the tax return, knowing that on the tax return it was 3,500, on the income statement it was 12,000. So if we're going to make them the same, if you will, we would need to add back $8,500 on the tax return to make the bad debt expense down to 3,500 instead of 12,000. On the other hand, depreciation is calculated by taking the difference between the two. But on this side, it's negative, right? Because there will be more depreciation on the tax return than on the income statement, just the opposite. So here's a future taxable amount, here's a future deductible amount. We get the same taxable income, same tax expense, same journal entries as when we did it before. Tax expense, deferred, all that good stuff, all that, including our rate reconciliation, because our terminant differences haven't changed at all. So they're the same, and so the reconciliation is the same. Tax expense is still from over here in this calculation. So just a little more practice on this way of doing it. If we go to the year 2, again, we're tracking the same differences, but we start this time with income before taxes. We subtract the interest on the bonds, add back the life insurance, so two permanent differences. And we're looking again at the difference between bad debts on the tax return and on the income statement. The difference between the write-offs and the amount of the allowance estimated. So always go back to the T account to look at that and see what the difference is. Unearned revenue, because it's new, is all a difference. And then we did the difference separately for the 2015 equipment. All right, so the second year of depreciation for makers is calculated using this formula. Second year straight line, just like we did the first year, except no half-year convention. So in this case, the tax depreciation is actually lower than the book depreciation. So we add back some on that depreciation. And then the other asset we bought new in this year, we took all of it, Section 179, 7185, and took the difference between that and 719, which was the depreciation for the income statement. Take the cost divided by 7, divide by 5, divide by 2. And we get down here and get the same taxable income as we did when we did it the other way. but we have just one column and we're looking at differences. We still use the cumulative differences to do the journal entries, just like we did before, so that doesn't change. Tax expense is still the taxable income times the tax rate, and each of the journal entries take the cumulative difference, multiply by the tax rate, and then compare to the year before to see how much you need to change in terms of the journal entry. Rate, reconciliation exactly the same, and our schedule of current and deferred taxes is the same. So that's just a way that the information may be formatted differently. Hopefully, if you could do it either way, if you're told that you are starting with income before taxes and then the differences are described, or if you have some kind of common spot you start and just make the changes to both the income statement and the tax return side by side like we did before, we should be able, between those two ways, you should be able to handle most situations in real life in terms of being able to calculate the tax and the tax expense, given the side-by-side tax return and income statement.